Welcome to Money Flow IQs, where smart money meets smart learning.
Dive. Today, our mission is, well, it's absolutely critical if you're serious about building real financial wealth.
Yeah, absolutely. Because we're starting with a pretty startling statistic from our source material.
Get this. 90% of people who try to invest actually end up losing money in the markets. 90%.
It sounds brutal, I know, but it really highlights a key truth. Most people, they fall into these common avoidable traps.
So what we've done is synthesize a whole stack of analysis detailing these big errors investors make.
And we're laying out the 7 traps you really need to spot right now. The goal is to help you avoid them and, well, join the 10% who actually succeed.
Okay, let's dig into this. We'll follow the mistakes one by one, starting with maybe the most basic foundational one.
Right. Mistake number 1, just not investing at all. Seems obvious, maybe.
Yeah, but it's the most common issue, right?
It is. People get stuck. The sources call it the 2 S's, spending or saving.
Ah, the spending trap. I think everyone can relate to this one. The data shows somewhere between 55% and 75% of Americans are living paycheck to paycheck.
Exactly. Spending pretty much everything that comes in on, bills and just stuff.
And the analysis had this specific, maybe slightly embarrassing comparison. Over 70% of Americans have a Netflix subscription.
Right, meaning a lot of people prioritize that monthly entertainment cost over actually putting money aside to invest.
Okay, so that's the spending trap, but you said there's a second S, saving.
Yeah, the saving trap. This is where you avoid overspending, which is good, but you just hoard cash. You save everything, but you don't invest it.
Okay, I get saving is crucial for, emergencies, but why is just saving disastrous for building wealth? Shouldn't you be rewarded for being prudent?
Well, the problem is inflation. You're absolutely guaranteed to lose buying power over time if your money's just sitting there.
How does that work exactly?
Okay, so let's say your savings account gives you maybe 0.5% interest. Pretty typical, right?
If you're lucky.
Right. And let's say inflation is running at, say, 3%. Well, your money is actually losing about 2.5% of its spending power every single year.
Wow. Okay, that's a big shift in how to think about it. The number looks safe in the bank, but what it can buy is shrinking.
Exactly. It's this deceptive kind of security. Think about it. If you manage to save $1 million,
Yeah.
and you keep it in the bank, which feels totally risk-free, right? You're actually losing around $25,000 in buying power every single year.
25 grand just gone. Poof.
Yeah. So the fundamental point here is investing, actually putting your money to work so it can grow, that's the engine for building wealth, not just saving cash.
All right, that makes sense. Moving from foundational errors, mistake number 2, the casino effect. This feels like the total opposite of just saving, taking way too much risk.
Precisely. This is treating the stock market like it's, Vegas, like gambling.
How does that show up?
Well, you see it in how some modern trading apps are kind of gamified. They encourage constant buying, selling, flipping. It turns investing into just speculation.
I can see the appeal, though. I mean, the average market return is around 10% a year? The source even said that sounds kind of boring and dry.
It can feel that way, yeah. Especially when you compare it to speculative things like, say, Bitcoin, which might average 100% or even more in a really good year. Big, sashy numbers.
So why isn't chasing those huge returns the way to go?
History gives us the context we need here. Think about Warren Buffett.
Okay. Legendary investor.
Right. Multi-billionaire. One of the richest people ever. How did he build that fortune? By compounding an average return of around 19% a year.
19%, not 100%.
Nope, 19. Consistent, powerful growth compounded over decades. And that 19% average is amazing because he maintained it through all the ups and downs and the booms and busts.
That consistency, year after year, through everything. That's the key, not the wild speculation.
Exactly. But what about those volatile things like crypto or maybe startup investing? Is there any place for them?
Yeah. Do they fit in a smart portfolio at all?
They absolutely can. But, and this is crucial, you have to size them appropriately. History shows we've had, 16 recessions and maybe 25 market crashes in the last century?
Yeah, markets definitely go down sometimes.
And when they do, those super speculative assets, they fall way, way further than the broader market. So the approach the sources recommended,
What was it?
keep those high-risk things, crypto, startups, whatever, as a small, defined slice of your portfolio.
Did they give specific numbers for that allocation?
They mentioned one approach, maybe 18% for that speculative portion, and actually 2% for physical gold. But the key idea, the really important part,
Yeah.
is you size that risky part so that if it completely cratered, went all the way to zero, You'd be totally fine. It wouldn't wreck your overall plan.
Okay, so it's an accepted risk, managed risk, not a bet the farm gamble.
Exactly. It's not a gamble that sinks the whole ship.
Okay, let's shift gears a bit. Let's talk about the behavioral traps, the things that trip people up even if they start with good intentions. Mistake number 3. Missing the big market moves because you're trying to time the market.
Oh, yeah, this is a classic. It's driven by greed and fear, right? Trying to jump in at the perfect bottom and jump out at the perfect top.
Which is impossible.
Pretty much impossible. Nobody, not one person, can consistently predict the market's peaks and troughs. You just can't guess right all the time. There's that old saying.
Time in the market beats timing the market.
That's the one. It's true for a reason.
And the data on this is just, well, it's incredibly powerful. Bank of America looked at 9 decades of market performance, 1930 all the way to 2020. What happens if you just stay invested versus trying to jump in and out?
Okay, get this. If you just stayed in the market the whole time, your investment grew by an incredible 17,000%.
17,000%. Wow.
Now, if you made the mistake of trying to time things, maybe you got scared during dips, maybe you thought you could catch the next wave, and you ended up missing just the 10 best performing days per decade.
Wait, just 10 days out of 10 years? So 1 day a year on average?
Yeah, just 10 days per decade over that 90-year stretch. If you missed only those days, your amazing 17,000% return, it collapses. It drops all the way down to just 28%.
28%.
Yeah.
Versus 17,000. That's catastrophic.
It's catastrophic.
Yeah.
Missing just a handful of those really explosive growth days completely cripples your long-term compounding. You just have to stay invested through thick and thin.
Okay. That leads perfectly into the next one. Mistake number 4. Investing on emotion. We just established staying in is critical, but man, the market sometimes makes that feel really, really hard.
Oh, absolute markets go in cycles. And severe drops, they happen. It's predictable. We saw the S&P 500 fall, 20% in 2022?
Yeah, and 34% in 2020 during the initial COVID panic.
Right. And remember 2008. Down 57%. Or the tech bubble burst in 2000. Right. Down 50%. These things happen. And when they do, people panic.
And what happens when that panic sets in? What's the cycle?
It's almost always the same pattern. The sources use this memorable acronym, POOP.
POOP, okay. What does that stand for?
Panic leads to overselling, which then creates opportunity, which eventually leads to profit.
Panic, overselling, opportunity, profit. Okay, so people freak out.
They freak out. They sell perfectly good investments at rock-bottom prices.
Which creates a bargain for someone else. Right. An opportunity.
Exactly. It creates a buying opportunity for investors who keep their cool, who are thinking long-term.
So counterintuitively, the downturns, the scary times, that's actually when wealth can be created, not just destroyed.
Precisely. Market downturns, crashes, recessions, they actually create more millionaires than any other time because they allow those long-term savvy investors to buy great companies, great assets at a massive discount while everyone else is, running for the exits.
So you have to train yourself somehow to fight that emotional gut reaction to sell when things look bad.
You absolutely do, which ties right into mistake number 5, short-term thinking. Why is time such a critical ingredient here?
Yeah, why is the long game so important?
Time is what allows compounding to work its magic. The goal isn't quick flips. It's not day trading or options or Forex trying to make a fast buck. The real goal is ownership. Owning a piece of a solid business for the long haul, years, decades. The source even said, essentially forever.
Owning it forever?
Well, maybe not literally forever, but thinking in terms of very long time horizons. If you own that piece of a business long enough, you benefit as it grows, as it reinvests its profits.
Yeah.
Your own wealth just accelerates. It compounds.
And besides that compounding power, there's actually a big concrete incentive the government gives you for thinking long term, right?
Yes. That's a really key piece of evidence supporting this. If you hold an investment for longer than 1 year.
Just 1 year?
Just over a year. You qualify for lower long-term capital gains tax rates. It's a clear financial reward written right into the tax code, designed specifically to encourage people to hold investments for the long term.
All right, let's tackle something that often flies under the radar but can be devastating. Mistake number 6, ignoring fees. This might sound a little dry, but the comparison the sources gave us was, well, frankly, it was stunning.
Yeah, fees are sneaky. They often seem so small, like 1% or 1.5%, but they compound just like your returns do, except they compound against you.
Where do these fees typically pop up?
Oh, they're everywhere. In your 401k, with financial advisors, inside mutual funds, even in ETFs and index funds, though usually much lower there. The single most important term you have to look for, especially with funds, is the expense ratio.
Expense ratio. Okay, let's make that concrete. Walk us through that detailed example from the sources. Let's say you invest $1,000 every month for 30 years, and you get a solid 11% average annual return. What happens if you use a high fee option, like maybe a traditional financial advisor charging 1.5%?
Okay, so $1,000 a month, 30 years, 11% return, but with a 1.5% annual fee. Over those 30 years, the advisor takes roughly, get this, $600,000 in fees.
$600,000 just in fees.
Just in fees. That tiny-sounding 1.5% eats up over $500,000 of your potential growth. You end up with about $1.8 million for retirement.
Wow. Okay, now compare that. Same investment, $1,000 a month, 30 years, 11% return. But this time, you use a modern low-cost fund with maybe a 0.1% expense ratio.
Big difference. In that low-fee scenario, your total fees over the 30 years plummet down to just $40,000.
$40,000 instead of $600,000.
Right. And because you kept so much more of your money working for you, you end up with about $2.34 million.
So that difference in fees, just 1.4 percentage points, cost the first person over $500,000.
Over $500,000 difference. That's why fees absolutely have to be a top priority when you're choosing investments. It's not a small detail. It's huge over time.
Okay, that's the $500,000 reason to check your expense ratios, like today. Got it. Now let's wrap the mistakes up with number 7. Not knowing your strategy and then flinching. This seems to pull everything together.
Yeah, this is really about execution. It's about having a clear plan and then actually sticking to it. You have to align what you do with your chosen approach.
What are the main approaches? The source mentioned 3 distinct ways to invest long-term, right? Not trading, but investing.
Correct. 3 main paths. 1, you can be hands-off. Basically, you give your money to a financial advisor and let them handle it.
Okay. 2?
2, you could be passive. This means you invest mainly in low-cost funds like ETFs or index funds. You're managing the overall allocation, deciding which funds, but not picking individual stocks.
Got it. And the third?
3, you can be active. This is much more involved. You're doing deep research, studying companies, reading financial statements, listening to earnings calls.
Yeah.
It's potentially higher risk, but also potentially higher return.
So the mistake, number 7, happens when people pick one of these strategies. Say, they decide, okay, I'm going to be a passive investor in an S&P 500 fund for the next 30 years.
Right, they make that commitment.
But then the market has one of those inevitable downturns we talked about, like in 2020 or 2022.
And they panic, they flinch, they abandon the strategy, sell everything, often at the worst possible time. They didn't truly commit to the strategy they chose.
I want to understand the active path a bit more, though. What does that really involve? Sounds like a lot of work.
It is a lot of work. Being a successful active investor, it's essentially like taking on a part-time job, maybe even more for some people.
What kind of skills do you need?
You really need to understand how to read financial statements, balance sheets, income statements. You need to be willing to listen to hours of company earnings calls. And you need to constantly analyze economic trends, political shifts, industry changes, always looking for opportunities the market hasn't fully priced in yet.
So higher potential reward, but definitely requires significant effort and skill. And higher risk if you get it wrong.
Absolutely. You're taking on that research burden yourself.
Okay, so we've walked through the 7 big traps. How do the 10% who actually win at this game operate? How do they play based on the strategy they choose?
Right. Let's talk about the winning approach. If you choose the passive investor route, the guiding principle is simple. The source called it ABB.
ABB?
Always be buying.
Always be buying.
It means you invest consistently, regularly. Maybe it's every week, every month, whatever schedule fits your budget. And you buy regardless of what the market's doing, up, down, sideways.
Doesn't matter if the headlines are scary. Doesn't matter who's in political office.
Nope. You ignore the noise. You ignore your emotions. You just keep buying your chosen low-cost funds steadily over the long term. You set it, you pretty much forget it, and you let time and compounding do the heavy lifting.
Okay, that's the passive path. What about the active investor, the one doing all that research? How do they win?
Their focus is different. They're intensely studying what the source called market shifts. They're looking for fundamental changes in how money is flowing, where it's going, and why.
Can you give an example of a market shift?
Sure. Think about the pandemic. Suddenly, millions of people got pets, right? The pet boom.
Right. Lots of pandemic puppies.
Exactly. So an active investor would analyze that shift. More spending moving towards pet food, vet care, pet supplies. They'd research companies in that space, looking for undervalued opportunities created by that fundamental shift in consumer behavior.
Okay, that makes sense. Any other examples?
Or think about, say, major government actions, like imposing tariffs on certain goods or launching a massive infrastructure spending bill. Those actions redirect huge amounts of money.
And create winners and losers.
Precisely. An active investor studies those policy changes, analyzes the potential impact, and looks for investment opportunities based on that data and research before it becomes obvious.
That seems key. The active investor needs to identify these shifts and opportunities before they hit the mainstream news, before everyone's talking about it on CNBC or Reddit.
That's the edge they're looking for. By the time it's a major headline, a lot of the potential gain might already be gone. The opportunity is in seeing the shift early.
So, wrapping it all up, success really boils down to just two core things.
Pretty much. Number one, invest for the long term. That's mistake 5, avoiding short-term thinking. And number 2, strictly align your actions, your behavior, with the investment strategy you consciously chose. That's avoiding mistake 7, the flinching.
If you panic and sell during downturns, you lose. If you stick to your long-term plan, whether passive or active, you give yourself the best chance to win.
That's the game plan in a nutshell.
That is a really clean, actionable way to think about moving out of that losing 90% and into the winning 10%. Hashtag tag outro.
And just as we finish up this deep dive, maybe we can leave you with one final thought. Something provocative that kind of ties this net for a long-term strategy back to the very foundation you're building on. Remember a little bit of history. Back in the early 1970s, President Richard Nixon went on TV. He addressed the nation.
Yeah, I remember reading about this, the Nixon shock.
Exactly. He announced he was directing the suspension of the U.S. dollar's convertibility into physical gold, severing that link. And he specifically said the measure was temporary.
Temporary, but it fundamentally changed everything about global finance, didn't it? Taking the dollar off the gold standard.
It did. And here's the kicker. We're now sitting here over 50 years later, and that temporary measure, it's still the bedrock of the entire global currency system.
Huh. 50 years is a long time for temporary.
It is. So the question for you as you're building your own long-term financial strategy, if a temporary government measure from 5 decades ago still defines the fundamental basis of today's financial world,
Yeah.
doesn't that just powerfully reinforce the absolute necessity for you to focus on owning real, durable, high-quality assets for the truly long term, for decades, almost regardless of the day-to-day noise and shift built on that temporary foundation?
That's a really interesting way to frame it. Thinking about the permanence of your own goals against the backdrop of a financial system that's maybe not as fixed as we think. A great final thought. Thank you for diving deep with us today.
Subscribe for more smart money ideas every week.